All right, thank you everybody. Rob Barnes with Integrated Insurance Consulting. Today's conversation is long-term care, what advisors need to know, and we're going to get right into our material. So our goal is to help you have better client conversations about risk management. Today's risk management, of course, is the long-term care conversation. With our name of Integrated Insurance Consulting, it's pretty clear we're on the protection side of protection versus probabilities. But the probabilities for long-term care need are fairly high. And so we hope to give you a little bit more insight of how to have risk management conversations with clients. We see a lot of advisors doing risk by risk in a silo instead of maybe looking at all of them and changing what we ask or how we plan or put safety nets under clients. So we're going to look at the different products that are available today, where they fit, why they fit, and share with you resources. Everybody on today's call will get a replay of the presentation and a kit of services, excuse me, a kit of resources, including a few articles and educational things. And we'll share our EDU portal for you. We not only help advise and educate clients, but we help you educate excuse me, we not only advise and educate advisors, we help you educate your clients too. And that's what our client EDU portal is about. And for those that aren't so healthy, can't get the regular stuff, we'll address near the end some of the alternative strategies. So we probably all are sick of this statistic, but it's the most well-known statistic out there in the long-term care world, and that is once your client reaches age 65, they have a 70% shot of needing some kind of care within the rest of their life. But based on this pie chart, I like to look at it as a 50-50 shot. In other words, you have a 50% shot of either not needing care or just needing a little bit of care under 1 year. And we don't necessarily need to insure for the little things, it's the big things in life. So it's that other half, that red half, the left half of the pie chart that has some scary stats that you have a 52% chance of needing care longer than 1 year. And the ones that really frighten us are the dementia and Alzheimer's words. The reality is the statistics are scary by themselves of how many people are diagnosed each day with it, what the future is going to hold. They're going to have over almost a tripling over the next 30 years of those who have dementia. And these kind of stays are the ones that can really drain the bucket and the pile of money, 4 to 8 years on average. And we know that this graph here, the orange is for women and the blue line is for men, but this graph shows some of the longer claims that have been at different carriers. So again, the real scary part is here. But we know that on average, men are going to need 2.2 years of care, and women will need 3.7 years of care. And of course, those are averages. What happens if you're above average? When we look at the costs of today, we automatically think that home health care is cheaper, and it might be, especially if you don't need 24/7 care. But for those who do need 24/7 care or nursing care, it can be quite expensive, not only today, but tomorrow. So our home care stat just shows 4 hours a day on there. So imagine if it's 24 hours a day, how much more expensive it can be. And so these are just the realities. And I believe that long-term care costs, because of the shortage of caregivers, because of the aging of the baby boomers and the gen behind it, I think that the rate of inflation for care is well above the average rate of inflation going on right now. So it's only going to get worse, is the point. And I always find people's reactions funny in talking to them. That somebody will buy a lottery ticket for the one of the national lotteries where they have one in a gazillion chance of winning, and they'll buy that ticket and they'll think it's going to be me, it's going to be me. But we serve up statistics that you have a 50-50 shot of needing care for at least a year, and they're always going to point the finger, not look in the mirror. So I always find that a fascinating thing about how people respond with their emotions. And look at, it won't be them, it'll be the other person in some cases, but yet for the lottery ticket, they're going to win. Now, for those who know me, I'm a big music fan and I'm always quoting lyrics. And unfortunately, last year we lost one of my favorite singer-songwriters, Todd Snyder. But I bring up his Statistician Blues song, and in it he sings that 65% of the statistics are made up on the spot, and 82.4% believe them, whether they're accurate statistics or not. But in his refrain is what I think resonates about long-term care and perhaps some other protection planning things. Too much to think about, too much to figure out. I'm stuck between hope and doubt. And so today we want you to perhaps find out what you believe. And if you believe one way about probabilities or protection, maybe your clients think differently. And it's not good to assume each client is going to think the same way or perhaps dish out the same advice for every client because some situations are unique. And so what we really want to do is help you help them get a plan. And there's two big questions that they need to resolve. Who's going to care for you if you need care? And how are you going to pay? Those are the two big questions. And so we have the options of family or government or self-insure or buy insurance. And so let's break these down each way. So again, in the insurance business, I know that people don't like to talk to me for certain products and stuff because I'm all about death and destruction and such. But um, the reality, when you ask some clients if they have a plan for care, they'll often bring up, and usually it's the female spouse that will bring it up more so than the male, that the kids are going to take care of us. And the next question I have for them is, well, have you had that conversation? Have they agreed to care for you, or is it just in your mind that they're doing it? And so that's a good question to ask if, in fact, they're telling you, oh, we don't have to talk about this with you, our planner. We're all set. The kids are going to take care. And then if you're trying to get referrals, when you're working with your younger clients, you might reverse it and ask your younger clients, are you familiar with what your parents' plans are for their long-term care support someday? And how do you know it's not you that they're thinking about? So we've certainly have some younger, well-to-do clients who've purchased long-term care on their parents because they know it'll help save their assets down the road, especially when parents don't have much. So, although this is a very viable option, it happened in my family. I'll share a little bit of that here that we were able to support my dad for a while. He had Alzheimer's. That scary one we just left. And the reality was we did most of the caregiving until the very end when we had to have some outside support. So make no mistake that unpaid caregiving is not free. Somebody's paying a price for it. It might just simply be dignity. And the thing that I'm grateful about my dad's situation, he passed in 2023. But my niece, her husband is a nurse, and he saved me from the psychological damage of having to give baths to my dad. So that's a cost of us caregiving, if you will. And they didn't have the other means and they didn't have the insurance in place as well. So this was the reliance, this, or if he went on very long, much longer, we might have been doing a Medicaid spend down in their situation. But that said, near the end, watching my dad shrivel up, I'm not sure I'm I'm going to get out of my brain that struggle, gurgling noise of him trying to breathe near the end. So certainly, caregiving had its toll on my mother, and us kids and grandkids that helped out with the situation. So, um, what we know as well is when somebody has long-term care insurance, it's real easy for them to say yes to getting outside help. In fact, I recently had a conversation, a long tenured agent in the business. He's retired now. Occasionally he'll send some clients that need some help and stuff. And he himself just started getting long-term care on his policy. He was living at home and now he's shopping for assisted living. And it resonated with him. He goes, you know what? I see it from the inside out now. It was a no-brainer for me to start getting help because I didn't have to pay for the bulk of it. I had insurance to do so. So it made it an easier decision. I think that can provide more dignity and peace of mind to people as well. And so, you see on here a caregiving resource guide. That'll be one of the pieces in our kit that we'll be delivering. So, is it the government that's going to pay? Well, Medicare only pays for limited stuff. Often they'll only pay up to 100 days after a certain hospitalization stay. For those who have very little in assets, you're going to be headed towards that Medicaid trajectory, spending down your assets. And of course, I think we all are aware that the quality of care is very much diminished when you go to a Medicaid approved facility, or at least that's been my feedback from people. The Medicaid spend down, I don't know about your state, but in Illinois, they only let you keep $2,000 as a single person. If you were married, they would let you keep 109, your house and your car. And the rest has to be given up. So that's the government option, which few want to do. And the government is burdened with all kinds of things, and it's only getting worse. So I think that's going to be even more of a strain. And even though you get a Medicaid spend down, maybe you won't find a bed someday. So, whose money are you going to use? Your money or our money as far as the insurance industry? And the likely answer often is some of both. My experience in talking with advisors and clients is they don't necessarily expect all of their costs to be paid by the insurance. What they're trying to do the most is preserve the pile. If they can use the yield from the pile, incomes from Social Security, pensions, and such, if they could use that money and use the insurance benefits and preserve the pile, and if they're diving into the pile, at least they can slow the bleed with insurance assets. So the question with self-funding option is, are you going to have enough? It's real easy to say somebody worth $10 million has enough money to self-insure long-term care. But I'm going to share with you a story in a couple of minutes that we place long-term care products on high net worth people on a regular basis. So if you're not asking them, if you're assuming or inferring, I personally would encourage you to ask all of your clients and let it be their option or have some say in the mix because they might think different than you. And even if they can do better investing versus insurance, they might prefer the safety net, is what I come to find. So with self-funding, you can have a reverse mortgage. That's certainly something that, if you had no other insurance, a certain size estate, I think entering retirement with a reverse mortgage line of credit is a smart thing to do at times. And then understanding there's a difference between having the money or the pile of money to be able to pay for care expenses, but it's another to take into account the shrinkage and the timing of taking money out. If all your money's in a large IRA account, then you got to pull 30 cents on the dollar to pay for care and that shrinkage. If the market's down 15% this year and you can't wait for it to rebound to grab some money to pay for care, then you're going to see assets shrink from that scenario. So we had a case, I like to tell the story. This case is fairly old, 15 or more years back. The client was worth more than $20 million. He was a retired executive from a major 8 accounting firm. And we were working with the client to place some second to die life insurance on him. You see, he was on 401 of estate planning. He gave away all his unified credits at the time. He was max funding, max using his annual exclusion credits. And he knew that the other value of things that he could do was to buy some life insurance. But along that way, and he bought a considerable six-digit premium life insurance policy, but along the way, he also asked us about long-term care. And it took my advisor a little bit back, and we ended up placing a Lexus plan on him that was a 10 pay with unlimited benefits and all that. And it was important for me to get into his mind. I had already built my credibility of being there along the way with my advisor. But I asked him, Mike, a lot of advisors are trained not to even talk about long-term care with rich people like you. What made you purchase this coverage? What was it? And he simply stated, he goes, well, look, Rob, I don't know if I'm going to need coverage or need care someday. I don't know if my wife's going to need care someday. And if we do need care, I don't know how long we're going to need care or what that care is going to cost. And that all sounds like a blank check to me. And I'm just not in the habit of writing a blank check. He understood that he was taking some cash flow out of his estate, that his kids wouldn't get half of it when he died, right? Or when they both died for estate tax net. He understood he was taking some assets out, but in his direction, he goes, look, I don't have to worry about that now. You do. Now, he didn't mean me personally. He meant the insurance company, of course, that he transferred the risk and he understood the value of doing that. Whether or not he could pay wasn't the thing. He was going to not have a blank check potential expense down the road. So I love that story just because it's true and it resonated and was a aha moment for me and my advisor at that time. So does it make sense to preserve and leverage the assets, create some tax-free benefits, and get the quality care you need by having proper insurance allocated? So we're going to address now the three different flavors of long-term care and get into each one of those. So um, what I'd like to share, things are simple from a cursory level, the bird's eye view, if you will. In life, everybody we meet, including each of us, is either going to live, die, or become disabled. Now, if you live, you aspire to have a pile of money or a stream of income to live off of. If you're worried about running out of money, I work with lifetime income annuities, so you know that. And the ROI that a lot of clients are concerned with these days is not return on investment. It's the reliability of the income. So if you die, life insurance might be important. And if you need long-term care, of course, that's the today's subject, and you will value it if that ever happens down the road, is generally what I find with people. And so the economic outlook has changed for your clients. If you discussed long-term care 3, 4, 5 years ago, we're probably in a totally different situation. And even though they didn't have as much fear before, they might have more fear of the scenario. So ask and ask again, because sometimes perspectives change. One of the things that I'm finding out more and more is that certain advisors are having really, they're having investment versus risk management conversations, but they're doing it in silos. So as far as longevity risk, do you or don't you want lifetime income? And of course, you run numbers and you show this. And then when it comes to long-term care risk, well, do you or don't you want that? And should you have money that's safe and won't be subject to a bad sequence of returns, especially a couple years before you retire or early in retirement? And what is the cost of liquidity? If you don't have a lot of cash on hand and you need care someday, what's the access? What's the shrinkage to your assets? And so I think the question that is more pertinent for clients is to ask about which risk you want to insure and which risks will you retain. In other words, put them all on the table, protect that pile, And how are you going to protect the pile? One person might prefer an annuity, one person might prefer long-term care. Obviously, some people and a lot of people go without any of these things, and maybe that works out for them later. These kind of products just add to the flexibility and increase the positive outcome happening. So you can cash flow analysis everything. And I get people, they send their client to me to talk about long-term care. They say, my advisor ran this report, and they said, I'm probably okay if I have a 4-year event down the road. And okay, well, what if you have a 6 or an 8-year event, right? We can't cash flow everything. And so again, are we projection planning? Is a question that I have. Are we projection planning versus having a safety net under the client? Because I don't know the future. They don't know it. You don't know it. I just know that the regret of having insurance is a lot less. What's the larger concern? Needing the coverage and not having it, or having it and not needing it. So when you look back, hindsight's the only thing that's clear, right? I see people struggle between the flavors of long-term care. And I'm like, look, you're not going to know today what you should have bought until tomorrow. And you might look back and have a little bit of regret that you bought A versus B, but all three of the flavors of product take some of your money out of the pile, leverage it into a tax-free pile that you can access if you need care, and thus they're providing what I do. I put safety nets under people and I provide peace of mind. I add flexibility and increase a positive outcome potential by having insurance products intermixed with the financial plan. So, moving on, I think that the long-term care can be, the subject can be discussed with, it's about asset protection, it's about asset leverage, it's about providing dignity to clients, getting the care they need, not having to have their kids, giving them baths and so forth. And then they can buy time. And all of this is relevant to what net worth your client is, right? And how your client thinks. And so, buying some time with long-term care, we know that we're not supposed to help clients with Medicaid spend down avoidance, if you will. But if you have 5 years of protection and mom's heading towards Alzheimer's, maybe you do want to get some assets out of the plan, out of the estate, and avoid turning them over later, especially if they're a modest amount of assets and they care about legacy. So in my world, if you could tell me which one of your clients are going to need care someday, we would just insure them. But it doesn't work that way. And no matter what statistics I share, when you are the statistic, none of the other numbers matter. You can have a 50-50 shot of not needing care or not needing much of it, but what if you're in that 20% quartile that's going to need care for a long time? Now everything might change in the plan, and that's when these extra protection and safety nets can come into play. So we're creating tax-free cash and avoiding shrinkage by having these products available. So I just want to pause. If you came in late, we need you to log 50 minutes today. We're going to go past we're going to be the full hour. We'll ask Q&A. If you have questions, put those in the chat box. I'll get to them at the end. You'll get a recording of this. And most importantly, if at the end of the presentation, there will be a survey in your browser. I appreciate you filling in the full survey, but at least please fill in your CFP code or let us know that you're not a CFP. So this grid is from our friends at Lincoln, and it's a good way to kind of show the value of these products. Self-funding has no leverage to it, of course, and then we have hybrid solutions as they show, annuities with riders, life insurance with accelerated riders, the combination products, which are the true hybrids, and then traditional long-term care. Now, I know the industry says anything that has anything to do with long-term care is now a hybrid product, right? If it has a life insurance or an annuity benefit and long-term care. But I have three categories: traditional, hybrids, and then life with rider. Life with rider is unique in its own category, in my opinion, and I hope to show you that. So the first thing we look at is traditional long-term care insurance. I call it pure protection. We can analogize it to auto and homeowners to help a client understand it better. You're going to pay, pay, and pay. You're going to probably have some price increases over time. And if you need care someday, you get benefits. And if you don't need care, there's money out the window. Now, when I'm comparing these, I want them to be relevant for you. So in the orange, the examples we're going through are a female age 60 in standard health, not preferred. We're building a 6-year bucket of protection and 3% compound inflation, and it's the premium that's equal in all of them. So we're going to look at different buckets of protection based on paying $10,000 for 10 years for this 60-year-old female. So if she buys traditional long-term care, she starts with a $240,000 bucket. She has accessible monthly amount of $3,300, and those numbers by age 80, she'll get $6,000 per month, and age 80, she'd have $435,000 of protection bucket. Now, these numbers are linear, so no doubt $6,000 a month is barely enough to get you some coverage today, let alone what it's going to cost at age 80. So if you want more protection, you can double the premium and you'd get double the benefits, and obviously cut it in half if you don't have $10,000 to spend. In my world, some protection is better than none, because it raises the bar on where your safety net is. Now, a hybrid long-term care, these are what are most in vogue today, especially for older clients. So again, we have certain questions that we ask to kind of know what we should show and what we aren't interested in. And some of that will be in the information we share with you. But a hybrid was designed to overcome the two weaknesses on traditional. One, there's money paid back even if you don't need care. That's the death benefit. In this example, there's a $101,000 death benefit. So essentially, if they die in their sleep, never needed care, they'll get their money back and without much interest. The other benefit is you can cash out and get your money back or a substantial part of your money back. So you have the right to change your mind down the road. And so these plans are most in vogue. And the other benefit they do versus traditional is they guarantee pricing. Now, the traditional product I showed you is an anomaly. It's only available with one company that I'm aware of these days, and they do have a 10-pay product. So if your client gets through the 10 years, they can't experience a price increase for that. But we'll compare these side by side in a few minutes, and you'll see that the no-brainer here would be the hybrid over the traditional for this specific set of facts. So in this case, our 100,000, 10,000 a year for 10 years provides larger monthly income out of the gate, a larger pool of care. At age 80, I have larger amounts available than the traditional plan would have allowed as well. Now, life with rider, I call this a known outcome. And the reason why it's a known outcome is the death benefit that you buy rarely is going to grow. There's exceptions to a lot of things in my world, so I try to be careful on the words always or never. But in this situation, the pool of care is the death benefit. And so it's a known outcome because the 10,000 for 10 years that she spends on this is going to make sure that 267,000 is either paid to her heirs at her death or to her for care, or a combination of the two. If she uses 100,000 for care and dies, the other 167 is paid there. So if we had a preferred female age 60, the numbers would be a little bit bigger because she'd buy more. And note the known outcome, if she lives to age 80 and then dies at age 80, the net return, the IRR on the death benefit versus the premium is a 6.05 net return, net of expenses, net of policy, net of management fee. And if she lives to 90, it goes down to slightly under 4%. And most permanent life insurance policies will have a bond type yield around life expectancy and beyond. So some can grow and be better and so forth, but we're looking at a pure, we're not trying to drive a lot of cash value in this kind of design, but this is a guaranteed policy, by the way, guaranteed age 100. So you're clear. So those are the three flavors: traditional, hybrids, and life with rider. Now, what we know about long-term care insurance is if the longer you wait, the more it's going to cost, and the more likely you are not to get approved for it because you have health conditions that start. It's all downhill after age 50, as they say. And so you can see the statistics of what percentage of applications are denied down the road. And if we have the foresight of this, if we know that someday we're going to want some long-term care, well, what if our 60-year-old client didn't wait till 60 to buy it? What if she bought a policy at age 40? She would spend $4,000 a year for those 25 years. That's the same $100,000 outlay as the example we used. Her death benefit would be shy of 500,000, and her monthly benefit accessible from day one, 4% of the 491 would be the 19,000 a month. And so again, life insurance is a different conversation than any other insurance out there because death is not an if. When you add a long-term care rider to these policies, it makes it a more multi-dimensional protection tool. And the sooner people see these, the future of long-term care from my perspective, and this is most true the younger you are, the future is long-term care rider on a permanent life insurance policy. Um, anyway, we will move forward. A couple years back, I attended a NAPFA convention. I sat in on a long-term care presentation by somebody, and it was asked by somebody in the audience, well, this is all great for, my 55 and 60-year-olds that are in the home stretch of retirement and everything. A lot of them will like a hybrid, whatever, but what about my young people? What can I do to protect them for long-term care today or tomorrow? And I wanted to blurt this out, but it wasn't my a presentation, not my place to share, but I'm sharing it with you. So there are some term policies that have some chronic and critical illness in some of them, benefits inside them. And this is one particularly that I like the most because a 30 or a 40-year-old can buy $1 million 30-year term policy and put this rider on it. And so if they were in a car crash in 5 years after purchasing this policy, they would be able to convert and start drawing off the death benefit at 2 or 4% of the death benefit per month until the full $1 million was gone. Now, the car accident in that example is when you're neck down paralyzed instead of waist down paralyzed, right? That's when you'd need care in that. And because waist down doesn't necessarily make you eligible for 2 of the 6 activities of daily living, so make you unable to do those. So in this situation, it's unlikely that car crash is 1 in a gazillion chance of it happening, but those things happen out there. What's most likely to happen is by the time she's 60 years old and she's in the home stretch of retirement and she's looking for some kind of long-term care protection, she's since in her past, she developed a condition or disease, something like an MS. If you have MS, you're not buying typical off-the-shelf long-term care products. And so these lock in, and this is where insurance is more than money. For those who look at long-term care, kick the can down the road, we'll decide tomorrow. Well, remember, it takes money and good health to buy that coverage. So these kind of term policies, which we definitely show people, that's our term conversation, which was last month, but we definitely do talk about these when we're talking term insurance with people to provide a better more comprehensive, robust protection tool. So again, the life insurance conversation is different than any other conversation. I've already stated, I believe the future, the younger you are, the more this is true. And so buy a permanent life insurance policy, add the long-term care rider to it, get it paid up before you retire, and now you have something going into retirement that you already have. You already have it paid up, and it's a flexible tool creating some cash-free or tax-free money if you need care later in life. In the long run, these offer bond alternative rates of return. And this term policy I'm showing you, you might look at it as kind of a call option to get long-term care later, that we were able to get you some some policy for long-term care later in life, even if your health has changed. So it locks in your good health of today. And then be aware that the inbred riders, the life with riders section and these term products, there's only a handful of term products that have these benefits in them, but make sure you're looking at one that's a dollar for dollar benefit off the death benefit. These inbred riders discount the death benefit. Now, again, better than nothing, and might be something that I put in place because I can't get you the other stuff in an underwriting situation. So if you go on claim and you own long-term care protection, there's only two questions that are important to you at that time. How much are you going to give me, and how long are you going to give to me for? Nothing else really matters at that. So we have to play the claims game for those that are not really sure which product they prefer and such. So I've learned to play the claims game a little bit with them. And so here's our three different alternatives, all based on the same premium outlay for the same female age 60. And note the traditional long-term care versus the hybrid, it's a no-brainer that you would buy the hybrid instead. Not only does it have a bigger benefit of protection, but it pays a death benefit if I go in my sleep, and it allows me to quit and get some money back down the road if I need to do that. And so this is a pricing anomaly. This is just where the market is. It isn't across the board. It isn't all ages and all health rate classes and so forth. But just be aware that we know this, and we know to check. Okay, you wanted traditional, but let me show you something that's even better than traditional. And that could be a hybrid for some people these days. And then the guaranteed life with rider, out of the gate, you have $10,000 a month accessible from the time you put this policy in place. So that's significantly larger than the others. And it takes all the way to age 90 before your monthly amount in the hybrid closes in on the same amount as the life with rider. So when we play the claims game, if I buy this in 10 years from now, if I buy any one of these, which one would I really have wanted? If I die in 10 years and I never needed care, well, that's a no-brainer. I want the life with rider because my heirs will get 267 back and I only spent 100 to get it. What if I die at age 80, but I needed 1 year of care before then? Well, you still want the life with rider under that circumstance because they would have paid out the 120 under the monthly amount available. They would have paid 120 out, and when you pass, your heirs will get the other 147. So those two win. But what if I'm age 90 and I have dementia? Well, that's an easy one too. I want the hybrid. I want the largest monthly amount with the largest bucket that I can have. And so this is the reality and the confusion, if you will, not only with advisors, because if you don't tell your client what to buy, sometimes they're even more confused than you. And my point with people is, look, don't try to get this right because only hindsight is going to tell you what was right. They all do what we intend. They take some of your money, leverage it into a bigger tax-free bucket, and protect the rest of your pile, or at least slow the bleeding of assets from your pile if the care is not sufficient to pay for all. Along with your cash flow. So again, remember it takes money and good health to buy long-term care insurance. And if somebody has legacy goals, it's important for me to know that. Then it's even more important to protect the pile, right? Or leverage the pile. And if they're unhealthy and they don't have the ability to buy long-term care and they have legacy goals, I start talking about maybe you want to gift that summer home away in an irrevocable trust so that if you ever get faced with a Medicaid spend down scenario, at least you pass that on if you want. And so a question to ask of yourself and your clients, should they remain self-insured? Now, if you're giving the same advice to every client, I don't consider that the right thing to do because everybody is different. We might have some guidelines, some predisposed thinking, but asking the questions again, ask your high net worth people and educate them about long-term care and why it is of value to them or can be. And but if you have single clients that don't have children, they might not have that family option available, right? And if they only have a modest bucket of protection, they might be worried about running out of money for income, let alone that being accelerated if they had a long-term care need. So those are things that you want to have discussions on. And I don't know where your asset level is, but to me, if somebody has a net worth of 600,000 or 800,000 or below, one, they're probably not working with a fee-only advisor in my experience. But two, they don't have enough money to take care of them and pay premiums or part with a chunk of that and so forth. So we can't help them, and is the reality of it. But decide if you're a protection or a probability thinker. Ask your clients what they're thinking and act accordingly per what they want, not necessarily how we think. My job, if you introduce your clients to us, is simply to go through and educate them, screen their health, see what their options are, design what they think they would want to do. And if they don't buy, that's fine. We've done our job. You did their job by sending them here. I did my job by consulting through, and they did their job by making a decision. Now, just because they made that decision today, as I expressed earlier, I think the world has gotten scarier in the last 3, 4, 5 years. And somebody who thought they were okay 4 or 5 years ago, they might think differently. And so maybe some of the protection products we worked with come into vogue for them. So most importantly, educate your clients and document your discussions. It's their liability or not to purchase. I can only lead them to the water. I can only tell them the value perspective of the products that I work with. And it's up to them and you to decide should they buy. And sometimes you might allow them to win, even if you think differently. So, some unique things. We'll just cover four of them real quick. Again, I want to, if you have questions, add them to the chat box. We'll get to those shortly. And we're going to stay on course here. These are four different ideas I'm going to walk through real quick and then share a few other things and get to our Q&A. If you want to pay your kids to be your caregiver, you want your daughter to quit her job and come be your caregiver, well, then you need an indemnity claims product that allows you to replace her paycheck with your paycheck, so to speak, and have the money to do it. If you have a reimbursement policy, they won't allow unskilled caregivers generally, and they certainly don't generally allow family, even if your family is a skilled caregiver. Now, for some situations, husband and wife comes to me and they have limited means for what insurance they can buy. Well, I might bet on just the spouse, the female spouse, I should say, of a husband and wife, same age. We know the stats. The female is likely to live longer. Walk in any nursing home in America, it's 70% women. And so I'll make the bet on the female. But I could also now, there's several joint products out. Maybe I just buy a shared bucket. So this shared bucket is based on that same 10,000 for 10 years. It's lower benefits, but again, it can help and it might be vital at a certain time. I've been asked along the way from some smart advisors that, hey, you know what? It'd be really cool if there was an umbrella like long-term care plan, like for property and casualty, where if my base policy doesn't cover what the claim is, then I have this umbrella kick in. So I'm willing to take care of some of my long-term care if it's short on the front end, but I want something to kick in later. And I explain this product to them because this is essentially that. We put a single premium of 200,000 in here. At the second death, if no care was needed, it'll pay out 244 to the heirs. Or when somebody needs care, it'll start paying 10,000 a month until the 244 is gone. That's your money. That's the deductible, if you will, or the waiting period. And now their benefits kick in. And in this plan, I show an unlimited lifetime at 10,000 per person. If they both needed care, they'd both be getting 10,000 per month on this for as long as they need it. And what if they're not really sure their marginal net worth line? They're thinking of it, they're thinking not, they really want to leave money to kids. Well, there's some other unique flavors of long-term care out there. This one is a second to die as well, but it doesn't pay for the first person that needs care. It only pays for the surviving partner, spouse, or partner. It only pays for the surviving or if both are on claim at the same time. And so note, this one has significantly for the 20,000. So we put the husband and wife 10,000 a piece together and 20,000 for 10 years. They have a pool or a death benefit of 681. And this is for those situations if we instead of thinking about self-insuring for both spouses, maybe we buy something like this, and your kids are not harmed from an IRR standpoint. If the second death occurs at age 90, they didn't need care along the way, the 681 gets left to the kids. And that turns out to be a 7% net rate of return on the premium versus the death benefit. And so for you to match that with investing, you've got to gross it up by a management fee and taxation. So not a bad thing. And again, this is a guaranteed product. There was no risk in it other than we designed it to age 100, and it'd be a little bit more if we wanted to design it forever. So some other things we look at when they're not healthy with it, qualified longevity annuity contracts. I've placed a number of these on people because they can't get any reasonable insurance amounts with their health. And this might be something you do for the surviving spouse, right? We have a husband and wife, and if we expect the husband to go first, maybe we set a QLAC up for the wife because she wasn't, if she lives long, then we have some extra income that kicks in. Now, that isn't a perfect substitute for long-term care, but the longer you live, the more likely it is you're going to need care at some point. And if you're draining your pile, eating into your assets and stuff, the longer you live, it's nice to know you've got some reprieve. And again, a QLAC could be used for running out of money as well as needing care later in life. There's deferred income annuities where it doubles the income if you need care. There's some that double or triple the bucket of what you put into them. Those are all things we use. They're not as good as the life-based hybrids, but they certainly have value to leveraging your dollar. And then in some cases, I'm working on one of these right now. The husband can't get long-term care, and he has a pension where the wife is going to lose half of it. So he has some term insurance. And I said, well, I can't get you anything reasonably priced for quite a while till you distance yourself from some health things going on. And we're looking at converting his term policy. And now, if he dies first, which all stats tell us he will, he's got some money left behind for his wife. Now, she is buying a hybrid for her in that situation. But if legacy is important and we don't have any term to convert, we can't get any life insurance, can't buy the long-term care again, maybe you want to give away that summer home now so that you know it's in trust and it won't get spent down if you do have some unfortunate need for care down the road. Now, I just want to emphasize here, I'm going to go through this. I'm really going to pass over this for sake of time of getting to our Q&A. But I want to acknowledge the payroll tax for long-term care that was established in 2023 from the state of Washington. And these kind of things really disgust me as to how people set these up and they think they're doing good for everybody. I think it's just another tax scheme. And they take money out of all the worker bees at 58 cents per $100 of earning. And they're providing $36,000 lifetime long-term care benefit. Well, what happens is somebody's not going to talk to their insurance guy about long-term care because they're going to say, oh, I'm all set. The state put something in place for you. Yeah, they put something in place that might pay for 3 months of care if you're lucky. And then they made it even harder to get. I don't even know what all of this, we're used to saying you go on claim with the two of the six activities of daily living. They require three of 10. And I don't even know what their 10 ADLs are, quite frankly, but that's what they set up. Now, behind them, California and New York, we're getting closer to doing stuff. And there's some other states, if you're from any of these, you might get it on your radar. Connecticut, Hawaii, Kentucky, Massachusetts, Maryland, Minnesota, and Pennsylvania. These were all people behind California and New York that might be putting something in play, but there's so much going on in the world. These, I think, have been dropped by the wayside. And again, we will address them as we see. We'll send out newsletters that if we hear another state imposing a long-term care program. So I hope that we provided some insight, perspective. You'll see the resources in a minute to have helping you have better long-term care conversations with your clients. Evaluate whether or not insurance should be considered as a funding option. Consider other risks that come into play, and do we want to cover any risk or have our pile be subject to all the risks, right? Utilize our resources, our EDU portal, but most importantly, document their desires and their decision. CYA there, right? You're not going to point the finger. I led you to water. You decided not to drink it. I just want that noted for the future in case it comes out in a different fashion and your kids are disgruntled down the road because a lot of your assets went to the nursing care versus them. And so utilize IIC for screening health, for designing protection planning, and for implementing that protection. And so you don't have to write this down right now, but this is our link to our EDU portal. We'll be sending these pieces along with that to you. There's a snapshot of these pieces. They really are designed to help you ask better questions, give some stats to your clients, and give a cursory level of it. But we're here as well. And here's a picture of my mug. Please send in your questions now, and that you got a quick look at me. I want to go to this just while we're going through the Q&A. We have our fall series set up. I have a couple of guest speakers coming in and some new perspective, new topics that I haven't covered. I only work with life, long-term care, disability, and fixed annuities. Please reach out if you'd like us to speak to your firm or your study group. We do CE all the time with people and have a lot of other courses made. And so with that, I'm going to breathe a second and take a look at any questions that we have here. So this question is good, thank you. Can you discuss policies for couples, shared care? Are these available and attractive today? So shared care is language leading to a traditional long-term care plan. And it says if I, the husband, run out of my bucket of protection, then I can invade my wife's bucket of protection. And so those do absolutely, they're available these days. In the hybrid space, they're joint products to start with. So there is no, it's a pool that either or both of you can draw from. So a little bit different there. And then this same person, and I think I know who this is. Hello there. Can you walk through the umbrella version of LTCi again? I didn't follow your explanation. So what I was getting to, so without long-term care, your full pile or a portion of it at least is subject to be eaten away for paying for care down the road, right? So the idea of a hybrid is take 50 or 100,000 and leverage your 100 into 3 or 4 or 500 and let it grow so that you only put the 100,000 of your pile at risk, so to speak, or only threw that away. You didn't expose a much larger part of the pile. And so the thinking of the umbrella is, I'll take care of the little claims. I want you to take care of the big claims. And so what I was showing you was a joint product from one specific carrier where it isn't exactly the umbrella, but it's as close as I can describe it, where your money was the 200,000 you put into it, And if somebody needs care, they're going to eat away at stage one of that product first. And once that 244 death benefit was gone, then they get into the lifetime benefits for the rest of the people. So again, we can talk one-on-one on that or go further if you want, but hopefully that resonates. So another question here, I'll get to that in 1 second. We are at the end of our 50 minutes. If you logged in a few minutes late, then stay on a little bit more through the Q&A. Want you to log 50 minutes to give you the CE credit. Thank you for reaching out to us and learning with us today. Keep us in mind if your firm or study group wants a speaker on insurance related topics as we do. And we'll see you in the fall, hopefully, for any of the courses that you see on the screen here. So, and again, in the survey in your browser will be our survey. At least please fill in your CFP code. If you don't have time after the call today, you got to run right away or get on another call. In 24 hours, you get another email asking you to complete the survey. We only need you to complete it once. So back to our question here. Can a traditional long-term care plan, 10 years old, be exchanged for a hybrid plan or a guaranteed life with rider plan? Owners are now 68 or 70. You're not really exchanging in the sense of turning that over to the new carrier and taking value from it or whatever. You are replacing it, would be the terminology I would use. I think we're saying the same thing with different wording. So yes, understand the horror stories that I still continue to get tend to all be geared towards the traditional chassis product. We had a company that went belly up. We have some others that are doing some very large price increases going on out there. And I might not necessarily be able to replace the full value proposition they have, but I can certainly guarantee pricing so they have no more surprises, and I can certainly leverage their money. And so if you'd like to reach out to talk more about your client, we can preliminarily look and kick the tires on what they have and what they would be doing if they went to a hybrid. And if things smell good, then I'm a big advocate of starting with screening health with people because, again, it takes money and good health to buy. And the reason we start with pre-screening is it helps me understand which of the three flavors is eligible to your client or available to your client and what the rate class might be. Just one thing on these hybrids that I didn't discuss earlier in my fast yapping. These products, these hybrids, most of them are pass or fail. And so if your client's not a certain level of health or better, they might fail. And that's why sometimes I can get you traditional but not a hybrid. Sometimes I can only get you life with rider with a baked in rider because we can't get the underwritten rider and so forth. So again, we avoid a lot of this if we quit waiting till 60 years old to start having a conversation, see what's coming at them, and perhaps look at these things at younger ages. I work with some well-to-do people, no doubt, on a regular basis, and you look at a 40-year-old who puts 50 grand into a hybrid and what that bakes into when they're most likely to need care in their 80s. Again, if they're doing well, they can part with the money, they understand the value. Those are things to look at. So thank you again for today. If you're signing off, we'll get you our kit and our replay. I have one other question that popped up here, and I'm staying on for the full next couple of minutes here. But can you use traditional 401k or IRA assets to pay long-term care insurance premiums? You can, but you're not avoiding the tax is the problem. And so this might be where we just have to look at the overall client situation. If that's the only bucket of money they have to pay from, maybe we set up a QLAC as a pseudo added income to help pay for care down the road. That's not perfect because if I strike the income start date at 80 or 85 and you need care at 78, well, it didn't help you there. But knowing that you're eating into your own asset pile, but you have reprieve of income might be something there. What this really means to me is that I would generally not look at lump sum funding a long-term care product. I don't want you to pull $250,000 out, pay 50,000 in income tax to give me 200 for two hybrids or a joint hybrid. We would probably look for paying over time so that we're using much less out of the IRA, and taking advantage of that tax deferral still in it. So again, in my world, it's do they need or want insurance is number one, and then if they do, how do they pay for it, right? And so yes, the IRA is some ways. Now, there's a company out there that has an automatic program where they can use IRA dollars to go into a hybrid product. And they want to make it like it's a big deal, but at the end of the day, now there is value there, by the way. They give you a little bit extra leverage in the product that you're buying if you do that. So I don't want to dismiss it, but I get advisors that bring that, they set in on that company's presentation and they think there's a magical way to get tax-free money out of the IRA to pay for long-term care, and there's not. The difference is, but this is where, maybe we shouldn't have overloaded the IRA if we think about it, right? We end up with a very large IRA at the tail end and we've got very little non-qualified assets. Maybe we should have looked at a permanent life insurance policy with a long-term care rider, contribute a little bit less to our 401k so that we now already have this in place and we don't even have to worry about it when we retire, right? We had it in place a long time ago. So, um, we have reached the hour. Thank you for learning with us today. I appreciate your time. I hope you look forward to our fall series. We will get things out to you in the next few days as stated, and you enjoy the rest of your day. Thank you again.